Today, we're rediving into a really interesting topic in the world of accounting: sale and leaseback. Transactions under IFRS 16. It might sound a bit complex, but I promise we'll break it down so it's easy to understand. So, what exactly is a sale and leaseback? Imagine a company owns a building. They decide to sell it to another party and then immediately lease it back from the new owner. The original owner gets a nice cash injection from the sale, but they can still use the building for their operations. It's a popular financing strategy, but how do we account for it? That's where IFRS 16 comes in. The first crucial step is to determine if the transfer of the asset actually qualifies as a sale. To do this, we look to another standard, IFRS 15, revenue from contracts with customers. We need to ask, has control of the asset truly been transferred from the seller to the buyer? If the seller still has the ability to direct the use of the asset and get substantially all of its remaining benefits, then control hasn't transferred and it's not a true sale. If the transfer does not qualify as a sale, it's treated as a financing arrangement. The seller lessee doesn't recognize the asset from its books. Instead, any cash received is recognized as a financial liability. The buyer lessor, on the other hand, doesn't recognize the asset. They recognize a financial asset, essentially a loan to the seller lessee. It's like the sale was just a way to secure a loan using the asset as collateral. Now, let us look at the more common scenario. What if the transfer does qualify as a sale? This is where it gets interesting. First, the seller lessee needs to figure out the right of use asset. This isn't the whole building anymore, just the right to use it for the lease term. They measure this right of use asset as a proportion of the asset's previous carrying amount. For example, if the present value of the lease payments is equal to 20% of the asset's fair value, the right of use asset would be 20% of the old carrying amount. After calculating the right of use asset, the seller lessee recognizes the original asset from their balance sheet. Then they recognize the lease liability, which is the present value of the future lease payments, just like in a standard lease. The final piece of the puzzle for the seller lessee is recognizing a gain or loss on the sale. But here's the key. They only recognize the portion of the gain or loss that relates to the rights transferred to the buyer lessor. The part of the gain related to the rights they've retained through the leaseback is not recognized immediately. This makes sense, right? You can't profit from selling something to yourself. Let's switch perspectives to the buyer lessor. Their accounting is more straightforward. Since it's a sale, they account for the purchase of the asset according to the relevant standards, like IAS 16 for property, plant, and equipment. Then, they account for the leaseback as a regular operating or finance lease, depending on the specifics of the contract. So to recap the seller lessee steps for a true sale: measure the right of use asset based on the previous carrying amount, to recognize the original asset, recognize the lease liability, and then calculate the partial gain or loss on the rights you've actually transferred. It's a logical process designed to reflect the economic reality of the transaction. Thanks for watching, and I'll see you in the next one.